Good morning. I have got the title, How to Improve Financial Stability and Resilience of Financial Institutions After the Crisis. And that's the outline of my presentation today. And let's first start. Why did we ever get there? The vast scale of the global financial crisis and its ramifications have been the main motivator of the regulatory reform agenda. It was endorsed originally by the G20. When the crisis began, the resulting economic downturn for a while resembled the pace of developments in the Great Depression. That's the only proper reference you can actually have when you analyze this crisis. Only the liquidity support operations by central banks at different stages and the explicit state guarantees to banks that were announced in different countries changed the course of developments compared to the 1930s. Paradoxically, the success in averting the worst that could have happened may be making some of us forget the lessons from the crisis too soon, or having us downplay the need for true reforms. However, it's crucial not to forget the crisis, and it's crucial to properly implement the reform agenda. At the same time, we need to get the regulatory reform agenda into completion in order to facilitate the bank's planning for their future. One important lesson from the crisis has been that we should better understand the point when and why the expansion of the financial sector turns excessive. Some recent research suggests that an excessively large financial sector may even turn from being a driver of additional economic growth, of being an impediment to growth. This was, for instance, presented this conclusion by Steve Ceggetti, who is the chief economist of the BIS. Surely, large-scale financial crises are very bad for the long-run accumulation of economic output, even if some crises might have a silver lining in the sense of promoting necessary Schumpeterian creative destruction. Especially when the financial sector grows rapidly into large proportions, the risk of a serious crisis is heightened. Focus on trading-related activities, the rise of new complicated financial products, and increasing reliance on short-term funding, market funding by financial institutions are symptoms of growing risks, as we saw in the years before the crisis. This time, the ultimate risk stemmed largely from the US housing market, but it had been transferred also onto European banks' balance sheets. This took place with the help of securitization and the related new financial intermediaries, generally dubbed as the shadow banking sector. As a result, the number of counterparty relationships and the ensuing counterparty risks increased. The global financial network became highly interconnected and complex. It is evident that many of these developments, by the crisis, did not benefit the real economy in a sustainable manner. The benefits of risk-taking were private, whereas the enormous cost of the crisis became the responsibility of the society as a whole. They fell to taxpayers. Profit were private, the losses fell to taxpayers. Why did the financial sector and its risks grow so much? And why were they funded by increasing short-term leverage, which added to the vulnerability? There were, of course, global macroeconomic reasons behind the crisis developments, but also failures of regulatory and macroprudential policies. There were also problems in the management culture of banks. Global imbalances, which was a big item early 2000, provided a fertile ground for the development of the financial excesses. Moreover, the monetary policy stance was accommodative in much of the early 2000s. Banks' capital requirements and liquidity buffers did not keep pace with the growing risks. Serious shortcomings in risk management within the Basel framework became apparent once the crisis hit. This was symptomatic in the slow growth of the risk-weighted assets relative to total assets in the years preceding crisis. There was also a lack of sufficient systemic view of the financial risks. Macroprudential tools and mandates to deal with such risks were largely missing. Another important reason concerns market expectations over public support if a large-scale crisis hits. As a result, many large and complex financial institutions appear to have benefited from cheap funding thanks to such too big to fail expectations. Cheap funding, which is insensitive to balance sheet risks, may easily spur risk-taking, especially when banking competition gets tougher. Sheer ignorance by bank management of the true risks may have also played a role. This was presented in one paper of Raghurajan, one of those respected economists who could foresee what was to happen. Is now our colleague in the central banking world, new governor of India, Bank of India. There may have been also a false sense of security resulting from the successful track record of monetary and macroeconomic policies. We spoke about great moderation. As a result, the markets placed their trust in central banks' ability to take care of liquidity if the markets were to be hit by serious shocks. These expectations may also have contributed to imprudent risk-taking, which, once the crisis started unfolding, led to real losses. These experiences underline all the more the need to develop macroprudential supervision and macroprudential policy. That is the first innovation and conclusion from the crisis. Macroprudential tools have to be applied when necessary to complement other policy areas in curbing excesses of the financial sector. Finally, as to the managerial failures, the transaction-oriented management and compensation culture of trading spread to more traditional banking. This provided incentives to risk-taking. Just 2 weeks ago, John Reed, who was the Citigroup CEO, very prominent central banker, gave an interview in the Financial Times. He described how this cultural mixing of trading and normal commercial banking had an impact on risk-taking. He said that in traditional banking, risk officers might easily say no if they judged a proposed new loan not good enough. However, if the loan officer's pay is linked to making new loans, as increasingly happened, then saying no becomes more and more difficult in practice. This is also well presented in the famous paper Raghurajan in Jackson Hole 2005. In sum, the challenge at hand is to implement regulatory reforms and policies which help steer the financial sector and banks towards more healthy practices, size and structure. The issue is no less than helping the sector to redirect itself to banking activities which support strong growth in a sustainable manner while maintaining financial stability. No one really knows what the right size of the financial sector is, but at least what we can do is to remove any perverse incentives which could lead to excessive growth of the sector and its risks. Then I go to policy reforms. Before the crisis, the benefits of deeper financial integration were pursued via market liberalization. Improving governance of financial markets was lagging behind, leaving the system vulnerable to crises. What we understand now is that liberalization and governance are complements, not substitutes. We need both of them to reap the benefits of financial integration in a sustainable manner. Much has been done already to improve financial stability and resilience of financial institutions after the crisis. First, Basel III agreement, which is implemented here in Europe through Capital Requirement Regulation and Directive, famous CDR4 and CRR, will strengthen banks' capital and liquidity position. This is a major step to improve banks' resilience. Basel III also tackles the too big to fail problem by imposing an extra capital requirement on international, systemically important financial institutions. Liquidity requirements, which previously did not exist, bring additional important resilience as liquidity typically dries up when the systemic crisis starts. Note that capital requirements also help maintain liquidity in the markets. When banks have higher capital buffers to absorb losses, there will be less need for fire sale of assets. And just fire sales especially seriously undermined market liquidity during the crisis. Second, banks' recovery and resolution tools have to be constructed. The key instrument is to make it possible to bail in bank debt in a crisis in order to avoid bailouts with taxpayers' money. This will be a key in restoring private market discipline on banks and thus to reduce the too big to fail problem. The importance of implementing the Bank Recovery and Resolution Directive, upon which political agreement was achieved this summer, cannot be overstated. In Europe, bank resolution, single resolution mechanism, is part of a larger aim of forming a true banking union. The other element is the single supervisory mechanism in connection with the ECB. Banking union project also includes a third element, the prospect of creating a common deposit insurance scheme. However, the first priority ought to be here to harmonize the national systems, which currently vary greatly. There are also a number of regulatory initiatives that intend to increase transparency in the financial markets. For example, accounting standards and disclosure practices are reviewed, and banks are urged to improve risk management and corporate governance practices. Supervision and regulation of derivatives markets and the shadow banking system are revised, including moves to central counterparties, which will help to address contagion risks embedded in the long counterparty chains in the over-the-counter markets. Macroprudential analyses and tools are being developed mainly on the national basis, but also in accordance with the Basel III and its application, which in Europe is Capital Requirement Directive, for the purpose of setting counter-cyclical buffers. Moreover, the European Systemic Risk Board, where we, together with Realkreditrådet, has published guidelines on the implementation of macroprudential tools across the EU member states. This is a highly important but challenging area of work where we need to see a lot more research to be done. The challenge is to find indicators which are able to warn early enough of looming vulnerabilities. Potential candidates are at least market prices, credit to GDP ratios, and changes in banking sector liabilities, as emphasized recently by Professor Shin from Princeton University. Finally, structural reforms of banks are already taking shape in some jurisdictions, such as the USA, the UK, France, and Germany, are being considered in others. The European Commission is supposed to come out still in the course of this autumn on how it might take further the proposals of the high-level expert group on bank structures, which I chaired. Leading European banks are very large in international comparison, especially in relation to the size of their home countries. Of course, you can discuss with it, that's a proper reference, but often it's the home country which is the final recipient of some problems if they ever emerge. In an ideal world, the externality imposed on the society by large, systemically important banks might be dealt with a single, optimally designed regulatory instruments. However, in the real world, subject to substantial uncertainties concerning the nature of risks and their measurement, it's better to rely on several regulatory instruments. Our group also came to the conclusion that although the regulatory reforms already implemented or in progress take us a major step forward, they don't take us all the way. We need further structural measures. Our group proposal focuses much on limiting the spillovers of benefits from safety nets, such as the deposit insurance, and to outside and core banking activities. These were the four main messages from our group. First, prohibit banks with insured deposits from engaging large trading activities whose risks are potentially high and difficult to measure. The message here is that because behind insured deposits there's either implicit or explicit government guarantee, this cheap funding should not be used in high-risk trading activities. Second, the crisis taught us a lesson. The complexity and interconnectedness was the main reason why the social costs were so high. Structural reform would reduce essentially the complexity and interconnectedness. It would make the banks easier to supervise. It would facilitate recovery and resolution, and would also make the pricing of funding of separate activities more efficient and risk-based. And finally, it would reduce mixing of the management cultures. This can be achieved by separating core commercial banking, which is allowed to take insured deposits from trading and market-making activities, which are not allowed to take deposits. Financial linkages between the separated need to be limited in order to make the separation effective. Trading and the bulk of market making should be moved together to the separate entity. This because it's very difficult to make the distinction between the two, and any rules would be prone to circumvention. The benefits of separation are the following. Separation would restrict risk-taking opportunities of a deposit bank. Moreover, it will reduce risk-taking incentives of a trading entity, because the funding of a trading entity will be subject to more effective market discipline in the absence of insured deposits. And as I said, the separation will facilitate resolution in a crisis situation. This will increase the credibility of resolution in market expectations and hence also enhance market discipline. Separation does not touch the universal banking model because the deposit bank and the trading entity are still allowed to be part of the same group. Moreover, mandatory separation would only apply to large institutions with major trading activities. Management, analyst following, and supervision of the separated entities with the group would be easier. Another important issue, which has been much discussed also recently, is that the regulations need to be robust enough. Robustness of capital requirements is needed because there will be always errors in risk measurements and managerial incentives to manipulate risk weights downwards will also be there. When we have studied how much capital really there is to cover, for instance, trading risks, you see that it's surprisingly small and vary from bank to bank. One answer is to add capital requirements which are not based on risk weights to complement risk-based ones. An important example is the leverage ratio requirement of Basel III. Our group considered, although did not directly propose, because this work is still going on in Basel, additional robust capital requirements on trading activities. If these were calibrated so that the robust requirements formed the bottom and the risk-based requirements came on top of that, then the bank's incentives to keep on improving their risk measurement technologies might be better maintained. Note that separation of trading-based risks from deposit banking can also be seen as a form of robust regulation. If potential errors in the measurement of trading risks may prove fatal to core banking services, it may be better to move the risks elsewhere altogether. This is what separation does. It compartmentalizes the risks within the banking group, a bit like firewalls help restrict the spreading of fire. Combination of structural reforms with capital and liquidity buffers may be a cost-effective way of regulation in the long run. Taking into account both public and private cons, bank equity capital is not as costly as one might deduce from banks' preference to use very high levels of debt financing. This point has been carefully scrutinized by the recent book of Admati and Helvig, Bankers' New Clothes. I mean, you can make also good critical comments on that book, but in the analytical side, some arguments are pretty sound. However, it's challenging to measure precisely how much bank equity will be socially optimal, although the crisis itself strongly suggests that levels of capital were far less than optimal before the crisis. So, a combination of higher capital and liquidity requirements, together with restrictions on deposit banks' risky activities, might be a balanced choice of regulation. Structural reforms may also contribute to successful macroprudential policies. This is because structural measures add simplicity and transparency of financial institutions and reduce their interconnectedness. As a result, the identification of good macroprudential risk indicators becomes easier and they can be measured with higher precision. The effectiveness of the respective macroprudential tools improves accordingly. As a counter-argument to separation, some have argued that by separation we lose risk diversification benefits. However, the crisis itself suggests that we may have overestimated these benefits while underestimating the effects of risk contagion, which separation helps to reduce. Regarding banks' recovery and resolution, our group made a proposal of additional designated bail-in instruments. This could be triggered in a relatively early phase of banks' financial distress to provide for recovery. Sheila Bair, the chairman of Federal Deposit Insurance Corporation in America, prominent, partly also controversial player in this discussion, just published her memoirs some time ago, and she made clearly the point out of her experience that the cheapest for investors and taxpayers is if you can already sell a bank in recovery phase. And if you have this type of instruments in recovery phase, that would make it more possible. The holding of these designated bail-in instruments would be restricted to investors outside the banking sector in order to avoid contagion. Similar ideas have been aired also by others, actually. In SOEF conference in Helsinki, Paul Tucker is still today deputy governor, but leaving next week in Bank of England. In comparison with other structural proposals, our group's proposal settles in the middle in terms of narrowing down the activities of deposit banks and in terms of the strength of the separation. And I want to conclude. Banks serve central functions in a well-functioning economy. Their role in providing finance to the real sector is particularly important in Europe. During this crisis, bigger companies are going more often directly to market, but still, for a big part of our businesses, practically for all SMEs, big part of bigger companies, for households, banks have the key role in financing of their activities. The regulatory reform agenda to prevent future banking crises is very ambitious, and it's essential to take it into completion. There are certainly short-term adjustment costs to the banking sector, but as societies, we must keep our focus on the long-term benefits. There have been many calculations on the cost of a crisis, If you compare, for instance, the margins you had to pay before the crisis, it's not the right point of comparison because funding was just too cheap. The risks were not properly priced. There will be costs, but that's not the point of comparison. But also assessments, very recent cost assessments from IMF are one good benchmark for these discussions. As regards the potential structural reforms in Europe, good implementation is the key to achieve the intended goals. And of course, international coordination of the structural measures as called for by BIS and IMF would be highly welcome. Both of these institutions have organized seminars or conferences where I have participated, trying to see if there's a common ground. Thank you very much.